July 31, 2005. The day a New York courtroom erupted as the judge slapped an 8 to 25-year prison sentence on Dennis Kozlowski, the flamboyant CEO who had siphoned more than $400 million from Tyco International and celebrated his own birthday aboard a yacht with a $2 million fireworks display. The world watched in stunned silence as the scandal that once seemed the stuff of Wall Street legend was laid bare, exposing a corporate empire built on deception, excess, and a culture that turned greed into an art form. Tyco International began in the 1960s as a modest electronics parts supplier, but under Kozlowski's charismatic leadership, it ballooned into a sprawling conglomerate of security systems, fire protection equipment, and office supplies, boasting revenues that eclipsed $40 billion at its peak. By the early 2000s, Tyco's name was synonymous with aggressive acquisitions and sky-high growth, and its board praised Kozlowski as a visionary who turned a modest firm into a global powerhouse. Yet behind the polished press releases and glossy annual reports, a darker reality was taking shape. The scheme hinged on a web of unauthorized loans, bogus consulting contracts, and inflated expense accounts. Kozlowski, together with his chief financial officer, Mark Schwartz, created a secret, personal use account that allowed them to write checks to themselves, their families, and even to a private jet charter company that never delivered a flight. Over a 5-year period, they diverted roughly $400 million in cash, stock, and other assets into their own pockets, masking the theft with layers of corporate paperwork and misleading disclosures. It wasn't just the money. In December 2002, Kozlowski hosted a lavish birthday celebration aboard the 165-foot yacht Nirvana, chartered in the Caribbean. The party featured a $2 million fireworks display, a 12-piece orchestra, and a guest list of Hollywood celebrities, CEOs, and political figures. The extravagant soiree, billed as the Party of the Year, became the visual embodiment of Tyco's excess, a stark contrast to the company's public image as a responsible, profit-driven enterprise. The first cracks appeared when whistleblower David Liu, a senior accountant at Tyco, alerted the Securities and Exchange Commission to irregularities in the company's accounting practices. In early 2002, the SEC launched an investigation that uncovered the secret, personal use account and a series of off-balance sheet loans that had been approved without proper oversight. Tyco's board, stunned by the revelations, fired Kozlowski and Schwartz in May 2002, appointing new leadership to steer the company through the storm. The criminal case built slowly as prosecutors painstakingly assembled a mountain of evidence, bank records, email trails, and testimonies from former Tyco executives who described a culture where the higher you climbed, the more you could take. In 2004, a federal grand jury indicted Kozlowski and Schwartz on 38 counts, including grand larceny, securities fraud, and obstruction of justice. The trial, which began in February 2005, captured headlines worldwide, not only for the sheer scale of the theft but for the theatrical drama that unfolded in the courtroom. During the proceedings, the prosecution painted Kozlowski as a master of manipulation, a man who believed his star status insulated him from consequences. They displayed photos of the Nirvana party, the $2 million fireworks, and the $500,000 gold-plated pistol that had been purchased for his office. Defense attorneys countered with a narrative of corporate mismanagement, arguing that the alleged theft was merely aggressive compensation and that the board had failed to provide proper oversight. Yet the evidence was overwhelming. A signed loan agreement revealing a $180 million personal use loan that had never been repaid, a series of forged board minutes authorizing payments that never received board approval, and a ledger showing that Schwartz had funneled $7 million into a private account under the guise of consulting fees. When the jury returned its verdict on July 28, 2005, it found Kozlowski guilty on 14 counts, including grand larceny, securities fraud, and conspiracy, while Schwartz was convicted on 13 counts. The sentencing phase was a media spectacle. The judge, noting the brazen extravagance of the crime, imposed a minimum of 8 years in prison with the possibility of a 25-year term, alongside a $45 million restitution order. Schwartz received a comparable sentence, and both men were stripped of their titles and barred from serving as officers of any public company. The aftermath rippled far beyond the steel doors of the courtroom. Tyco, reeling from the scandal, embarked on a massive corporate overhaul. New governance policies were instituted, including stricter audit committees, a revised compensation structure that tied executive pay to performance metrics, and a revamped whistleblower program that encouraged employees to report irregularities without fear of retaliation. In 2007, Tyco merged with Johnson Controls, creating one of the world's largest diversified technology and multi-industry companies, a move that many analysts credited to the need for a fresh start and a stronger brand shielded from past misdeeds. For shareholders, the fallout was stark. Tyco's stock, which had hovered near $70 per share in early 2002, plummeted to under $15 in the wake of the scandal, erasing billions in market value. Institutional investors demanded higher accountability, prompting a wave of legislation aimed at tightening corporate governance standards, such as the Sarbanes-Oxley Act's emphasis on internal controls and auditor independence. The Kozlowski case became a textbook example of the perils of unchecked executive power, cited in business schools worldwide as a cautionary tale of how charisma can mask corruption. Years later, the former CEO's life took another dramatic turn. Subscribe to the verdict for more stories like this.